Hi, welcome to today's video and thanks for joining me. Today we're going to be answering this question. Well, it's not a question, it's more of a tip. It's something that I've been seeing more and more of, and that is your beneficiaries, your kids and family members deciding to reside outside of Canada. So what do you do when your family members are living outside of Canada and you want to distribute the assets of your estate to them, but they no longer live in Canada? So today we're going to be answering that problem. How's that sound? But before we get into that, thanks for joining me. If you're new to my channel, I'm an active advisor working with individuals, families, and business owners right across Canada. I've been doing this for about 22 years. I love what I do. I'm very passionate about financial planning. I create my clients' financial plans, or if you're just an individual and you want a financial plan, I can do that too. But all my clients get financial plans. I manage their money. I'm also life insurance licensed, so I manage life insurance, and I help and teach business owners how to take money from their corporations tax-free. So with that in mind, and I also make videos, I really believe that the more knowledge you have, it leads to better questions, and better questions lead to better outcomes. So thanks for tuning in today. Have a look at the other videos on my channel, but let's get into why you're here today. Well, can you think of a better reason to get away from Canada than having to take out the shovel and move to a place where it just looks like this all year round? Wow, no choice there. But here's the problem. When you have beneficiaries that reside outside of Canada, there's a tax. It's a withholding tax for beneficiaries. So when we say beneficiaries, these are people who you want to give the assets of your estate to, so family members, kids, children that have moved outside of Canada. There is a 25% withholding tax. A non-resident beneficiary is subject to a domestic 25% withholding tax. This is what happens. You've passed away. May God bless you with 120 years, but you've passed away, and now you wanted to distribute your assets like you plan to do, but your children have actually moved and are residing outside of Canada, and now your executor has to hold back 25% in order to begin the process of making sure that he or she does not get into trouble with Revenue Canada. Now that's not what you had planned, but hey, your kids decided to live their lives, right? But there is a remedy for this. It's actually very simple. So the solution is very simple. You won't need a lawyer. You don't have to change your will. Your executor won't have to deal with this, so that's another good thing too. And there are no delays. So that sounds perfect, right? So it doesn't cost you anything to change this. So let's have a look at what it is. It's called segregated funds. Now, if you're not familiar with the segregated fund, I'm going to take a minute to explain that. But essentially what it is, it's a mutual fund offered by an insurance company, or we'll say it's similar to a mutual fund because it's not right to say it is a mutual fund. It is similar to a mutual fund offered by an insurance company. And so people ask me all the time, well, what can I invest in a segregated fund, or what kind of return can I expect in a segregated fund? And I keep telling them it's a similar thing to a mutual fund. So here's a little quiz for you. Have a look at this slide. There you go, mutual fund on the left, and a segregated fund on the right. They both hold the same underlying securities, almost the same weighting in terms of percentage. So to answer your question, what can you invest in a segregated fund, is not all that different than in a mutual fund. But it is very different in the way that, say, taxation, and the way the government treats how the money comes out of the segregated fund at the time of your passing. Very differently. And that's why so many people who are nearing retirement decide to move their assets into segregated fund, because it makes estate planning so simple, so straightforward, so smooth. So let's dig into a couple of points, okay? Mutual funds offer very little estate planning, and massive estate planning tool for segregated funds, which we'll get into, especially on the non-registered side. You can hold RSPs, tax-free savings account, LIRAs, RIFs, all these things, but a non-registered also is particularly useful in a segregated funds, especially the way taxation is treated. Probate fees in Ontario, 1.5% over $50,000, and because the segregated fund bypasses your estate, so it doesn't make up part of your will, it bypasses probate. So that's that issue of no probate fee is going to come off of your money, because it's going directly to your beneficiary right away. Probate takes about 90 days in Ontario. Well, because there's no probate in a segregated fund, the money is in the hands of your beneficiaries within, let's say, about a week, maybe 2 weeks, because it takes time for somebody to notify the insurance company that you passed. Other than that, as soon as the notification is received, about a week, the money is transferred into your beneficiaries' hands. Beneficiaries receive money on a mutual fund after taxes paid and after probate. So after your executor would distribute the assets of that type of portfolio after they receive a clearance certificate, whereas in a segregated fund, the moment that you've passed away, the assets are transferred directly to, not transferred, but paid out in cash to your beneficiaries before your estate is taxed. So the full value of that particular account, so if it's a non-registered account, the full value of that segregated fund gets distributed to your beneficiaries without any penalties, without any taxation. So it's pretty remarkable, and it's done pretty much inside of about a week. In CRA, and creditors come first on the mutual fund side, whereas your beneficiaries come first on the segregated fund side. So I kind of like taking charge of exactly what you want to have happen in your estate. Now, and the last slide I have for you is really just talking about guarantees. I'll just throw in an extra bonus for you here. On a mutual fund, when you have market volatility, as we've seen, if you go back as far as you want to go, there's market volatility. And when you pass away, sadly, if your portfolio is down, as we see on the left side, that's a mutual fund portfolio, your beneficiaries will receive the balance on that day less taxation, right? Then it goes out paying the executor as well. But whatever the balance is, less taxation, then that amount goes to your beneficiaries. Whereas on a segregated fund, a couple of things happen first before your beneficiaries receive the money. A segregated fund can protect, so it's kind of like a principal guarantee. A segregated fund can protect your balance. So if you have, let's say, make it $100,000. You deposit $100,000 and it goes up to $150,000. You can protect that high point by resetting the guarantee so that you're being protected, so that if the market drops, as you can see on the right side, what happens is the insurance company tops up your balance back to 150, so back to that high point that you protected your assets or protected your balance. Before they pay out the money to your beneficiaries, they're going to top up that balance back up to 150,000 and then pay out to your beneficiaries. So a remarkable protection that you get in a segregated fund that it does not exist on the mutual fund side world. Again, one of the biggest reasons why people choose to move to segregated funds when just before they retire or in their retirement is to protect what they've grown from market volatility in case they pass away. Think about 2008, 2009. It took 5 years for people's balances to recover. Now, someone passed away in that period of time trying to wait for the market to come back up. Had they had the reset function, they would have been able to top up their balances back up to that high point again. So a remarkable feature that many people don't ever get a chance to talk about, because segregated funds are only offered by an insurance company and only an insurance licensed advisor can discuss it. So you're probably never going to hear it if you're working with someone at the bank. And as always, I appreciate you for sticking around and watching this video. If you liked what you saw today, hit that like button, share this video with anybody you think needs to see this. And again, I look forward to seeing you in the next video. Thanks very much and take care.